Welcome to Business Talk on Business Tech with me, Michael Avery. Now, the first rule of banking is always say no. And there is good reason that bankers have earned the reputation of being fair weather bankers. You have to understand a bank's balance sheet. Now, a bank is the most highly geared entity in the world. It operates on a very thin sliver of capital, and the rest is equity. So if a bank has a bad debt, a non-performing loan, as it's called, it has to do a deal roughly 33 times bigger to recoup the original loss. If you lend out, say, 100 Rand at 10% prime, to use round numbers for the example, and the bank borrows at 7%, the repo rate, the profit on that loan is only 3 Rand. So you lose that 100 Rand and you have to do a deal 33 times the original size. It's why credit vetting matters and why I believe much of the criticism of banks for the failure of the Treasury Loan Guarantee Scheme is somewhat misplaced. To talk about how the South African unit of Investec Bank performed during the pandemic, I'm joined now by Richard Wainwright, who's the CEO of Investec Bank Limited and currently the chairman of the Banking Association of South Africa. So a couple of hats, Richard, that you wear. Great to have you on with both hats. Let's just dive into that first issue of the Treasury Loan Guarantee Scheme. And the president was quite vocal recently where he was critical of the banks. Where does the failure of the scheme lie from your vantage point at BASA?
Hi, Michael. Thank you for having me. Look, I think there's a lot of, how shall I call it, fake information around this loan guarantee scheme. Let's just put a few facts on the table. The scheme that was approved, and it was a scheme designed by National Treasury together with the Prudential Authority, the banking regulator, who came to the banks, approached the banks and asked them to enter into the scheme, which we did. The first point to note is, notwithstanding the media talk around it being 200 billion, the amount that was signed up for by the banks was in fact around about 68 billion. So it was never the intention to get to 200 billion. The amount paid out was around about 18 billion. Yeah. And if every single application had been approved, and there was about 50,000 applications averaging about 1.2 million Rand each, you would have got to just a little over 50 billion Rand. Was the maximum that ever could have been done. So I think the failure, it's not so much the scheme that failed. It was the fact that a lot was made out about the scheme being 200 billion when in fact it never was. So perhaps that's part of it. The other very important factor is the fact of the timing of it. You know, banks in South Africa, you spoke about highly leveraged with thin slices of capital. I think it is fair to mention that South African banks are of the lowest levered banks in the world. So, you know, significant amounts of capital with very healthy, strong balance sheets. And we saw that through the financial crisis in 2010. And in fact, what happened before the scheme was introduced, because this scheme really only came into effect in around about July, or June or July, what had happened was banks were already doing what we call voluntary relief to their clients, almost, you know, within weeks of the hard level 5 lockdown. And, you know, the information I have at hand, I know the Investec numbers quite clearly, but the industry numbers is around 450 billion Rands worth of loans were provided relief of some form, interest relief or capital relief or both. In Investec's case, you know, we publicly declared in our half-year results, 27% of all of our loans were restructured in some way. And that really peaked just before the loan guarantee scheme started. The impact of that information is that the demand for credit, the demand for the scheme was nowhere near what was originally anticipated by National Treasury and the regulators. So that, I hope, summarizes very briefly what had actually happened. But the banks played a very, very important role in the economy in supporting their clients.
And just like, and you referenced the global financial crisis, I think the one thing that South Africa can be proud of is the strength of our financial institutions. Once again, they've withstood some pretty severe macroeconomic conditions. They've come out on the other side flying. I know Investec wasn't included in the recent PwC survey due to reporting periods not really coinciding with the other 4 major banks. But it is remarkable at just how quickly the banks did recover from that initial lockdown period of April, May, June last year. What are you seeing through Investec's book in the business as a result of the pandemic? Because another big trend that we've seen is actually this K-shaped recovery, where if you can work from home, many professional and high-income earners, which really is Investec's sweet spot, are actually doing relatively well in this economy.
Yeah. So the K-shaped recovery, I've spoken about a number of times. It is a very real thing. I mean, the one thing this pandemic has highlighted is the inequalities in society at large, and in particular in South Africa, where, you know, millions of people have lost their jobs, but yet at the same time, a lot of companies have performed really well. And this gap between the haves and the have-nots, unfortunately, has just widened, in my opinion. So yes, Investec, we are a very niche bank. We operate primarily in the professional market, the entrepreneurial high net worth market, and mid-sized to larger companies. And that business model has proven to be more resilient. I mean, we're in a closed period right now, but if you look at our trading update and the guidance that we've given, you know, our ratios, credit loss ratios, are better than our peer banks here because of the type of clients that we are focused on. And interestingly, Michael, I think in the conversations that we have with international banks around the world, we've all kind of experienced a similar thing. There's an accounting standard called IFRS 9, and that requires you to make provisions for bad debts. And what you saw around the world, including in South Africa, was massive provisions for bad debts. But consistently, bankers telling us that the actual losses are not coming through yet. And they don't expect them to come through. So what you might see in the coming months or coming year is actually a reversal. We're seeing that international, a reversal of those impairments. So quite a similar experience both here relative to our international banks. And on the ground here, you know, post us getting out of level 5 lockdown, we have seen the economy start to bounce back somewhat. Unfortunately, I don't think it's creating the jobs that's necessary.
That is the macro challenge in the South African economy right now. We talk often about other drivers like technology and AI and robotic process automation. And history teaches us that what do companies do during downturns? Well, they tend to ramp up those levers that they can control, which unfortunately are not great for job creation in the local economy. Now, one can paint a gloomy scenario about the future. One can also paint an optimistic scenario. And if you look at what the JSE has done, SA Inc. Year to date, I think it caught many who were very gloomy about the prospects of the country wrong-footed. What is your outlook for South Africa from here? What is your upbeat scenario?
Look, I think the opportunity that this pandemic has provided, as you say, is the investment that's gone into technology, digital AI and the like. And you know, people prior to the pandemic were talking about the fourth industrial revolution around the world and how South Africa was going to be impacted by it. I mean, it can offer us a lot of opportunity. We can leapfrog. We can use this technology. And the amount of technological development we saw during the pandemic was absolutely incredible. I mean, even this call that we're on, this is Zoom. The beginning of pandemic, we were using Teams and WebEx, and Teams was a little bit slow. It's a Microsoft product. Within months, everyone was catching up. So, you know, the challenge for South Africa now is how do we use this technology to leapfrog basically our service delivery to the masses. So I like to talk a lot about mass scale education. I mean, I had a meeting this morning with some of our HR and CSI executives around how we use technology to scale what we do in that space. And I think that's where the private sector is going to have to engage much more closely with government around using the technological developments that have occurred around the world and how we scale it into the public sector, whether it be healthcare or education in particular, which is where we have a real interest. So that offers opportunity at a macro level. I think at a micro level, South African companies in particular, were never overgeared anyway. So we've seen certain sectors of the economy bounce back very quickly. Strong balance sheets, good management. We've got to get the macros right to get our investments up and to get on a faster GDP track. It is going to take us 2 years to catch up this lost GDP.
But within that opportunity, much like the story of Investec, I recall chatting to founder Ian Cantor, and Stephen Kossoff was on the call as well. And just recalling those days in 1976, the Soweto riots, the uprising, and the political risk was high, but it was a great time to start a business if you had the right idea and the balance sheet, because human capital is a bit cheaper, other resources are cheaper during depressed times. So those kinds of entrepreneurs who've got that balance sheet strength, as you say, who weren't highly levered, will be able to find opportunity. I want to zoom in on a micro level to two of the big opportunities that Investec, apart from obviously education, edtech's obviously a big one, seems to be playing in. And renewable energy is a massive one. ESG, environmental, social governance. And you've also recently done a deal with Vox on fiber. Just talk to me a little bit more about the role that you see Investec playing in those two areas.
Yeah, Michael, in the infrastructure space, I mean, we've had a project finance team now for about 25 years. And we've got some global reach with it. We've got a similar team in London, a similar team in New York. And where we do renewable energy financing, I mean, we've been very pleased to see this round 5 has been now announced finally. Certainly the capital, the technology is all available here, not just with Investec, with the full capital markets to support those programs. And we've now seen the president release the emergency power programs, and 8 projects now announced for delivery for power turn on in August next year. So that's all good. We need a similar type of thing on other forms of infrastructure, not just renewable energy. But the renewable energy space is going to be around for us for a long time now, and we have to transition over the next 30 years, maybe a little longer, away from coal to more renewable sources. And it's getting cheaper. Solar power is already substantially cheaper than coal. And in 10 years' time, the projections from Singularity University in America show that the cost of solar power per megawatt hour will be 1/100th of the cost of coal. So, that exponential curve is not going to change. We're on that curve. So more and more capital is going to be invested in that. You mentioned fiber. The fiber rollout in South Africa has been going on for a while. There are a few big players, and there's a number of emerging players as well. And yes, we announced our support of one of our clients recently, which you referred to, Vox. And they're one of a few clients who are aggressively rolling out the fiber infrastructure. The next phase, I would call it phase 2 of the rollout, is actually in the lower LSM areas, where we're going to get fiber into homes that previously are relying only on mobile for their data, and very expensive mobile data. So I think it's good for consumers in South Africa, broader consumers, to have this fiber rollout. And it's there's about 4 or 5 big players, and it's very competitive, and they're going to go at a very fast pace, which is good.
It's great for those who also want to work from anywhere. I was recently in Clarence, where I bumped into someone who's working on BASA, one of the country's leading crypto exchanges, and relocated to Clarence, which is 3.5 hours from Joburg, just as the pandemic struck, because they realized they could work from anywhere. As a bank, though, how have you found dealing with that challenge of remote teams, remote workforces? I know many CEOs I chat to, they say there are obvious benefits, but there's a cultural challenge as well. How do you build culture in an environment like that? How have you managed it?
Look, I think the initial challenges of getting 95% of our people working from home was massive. And, I've got to give credit there to our technology people at Investec and our HR people and all of the support staff that were able to do that. Because within a matter of weeks, we had 95% of our people working from home. But for us, it's not a sustainable model. We are very dependent upon teamwork, relationships. And, young people learn from their mentors at work. If you think back on your early career, as I've reflected back on my early career, I'm sure there were people that had a big influence on you. And you learn from that person, whoever it was, sitting in your studio or out on the road, interviewing someone, whatever it is. We all had that. Now, we've had about 250 people join our organization in South Africa during the lockdown. They don't know anyone at Investec. And my big fear is that they're not learning. So it's not sustainable. We will be a work from the office company, but with high degrees of flexibility. I think what this technology and the example you referred to is the ability to offer huge amounts of flexibility is there. But your culture gets built by knowing people. And a lot of innovation actually comes from teams working on a problem, solving a problem together with different thoughts and different ideas. Maybe young people can do it like this on a video conference. Maybe us older people find that a little bit more difficult. But certainly the relationships will get built. And the on-the-job training happens when you're working with someone. So we've been encouraging our people to try to get back to the office.
And obviously with that, there are opportunities in the property sector as we see things change. People might be looking for different residential properties. It's going to change the office market. But I agree wholeheartedly with what you say about culture. And my mentor, David Gleason, was one who firmly believed in relationships, in physical interactions. And often the smartest people in the room is the room itself. It's that perspective that you get from going around the room. And having had to do these kinds of interviews for the last year and a bit on Zoom, I can certainly attest to the fact that you lose some of that chemistry that you get in a physical, interactive kind of way. Staying on the technology theme and trend, though, obviously there's a lot of competition in the local banking sector globally. We've got new banks who are digitally native coming into the market. They're looking to steal and grab market share. It's more in the lower mass retail segment than you probably would find, I'm assuming here, in a mass affluent or entrepreneurial SME type segment that Investec is servicing. How are you seeing digital disrupt your business, though, and how are you responding to it?
Well, Michael, you may not know, we have 4,500 people at Investec in South Africa in our bank and wealth business. 1,000 of them is a technology person. So we've always considered ourselves to be we never referred to it like this before, but we do now. We're a digital bank. We've never had branches. Our clients engage with us largely either over the phone or digitally today. We only, in our private bank, for example, in our client base, we've got about 90,000 clients and we service them with about 500 bankers. You've got to be digitally enabled. So we do think of ourselves as a digital bank. We invest a lot of money in it. And our positioning, and each bank will position themselves differently. We want to be really good with technology. And so that our customers, whether they're corporate or private individuals or entrepreneurs, can engage with us digitally if they choose. So we want to be very high tech, but we also want to be high touch. So our mantra is we want to be high tech, high touch. We want to be good at both. And we think that offers a differentiated service. Well, we know it offers a differentiated service for our clients. Some people at certain stages of their lives will only want to deal with digital, no human touch at all. We think what differentiates our bank is our human touch, but you've got to be very good digitally. I don't think you can survive in almost any business today unless you have a digital strategy and you're pretty good at it.
Yeah, it's cross-cutting, and I think an important point there. Recently hosted a panel with Professor Tsalidzi Marwala, who's a leading thought leader on artificial intelligence. And he says it's not about having an AI strategy that sits outside of your business strategy. It's going to impact every single business in every single sector, from agriculture, primary, secondary. We see digital mines. So even those that require physical drilling and blasting are hugely impacted by all of these forces. If you look back on the last 12 months to tease out some lessons from the pandemic, We've obviously shown great resilience, great flexibility. What are your big lessons leading a team as large as Investec here in South Africa?
I suppose when you reflect back, I think the one thing that's come out of this is the level of interpersonal relationships within our various teams. Certainly at my executive team, going through a pandemic or a crisis like this together, you build very strong bonds. You have stories to, reflect on and talk about, and your relationships become very, very important. And I think it makes for a stronger business. The one thing I do worry about is what I referred to earlier, is I reflect back on the gap between the haves and the have-nots, and it's really worrying for me. And I think all of us are reflecting on how we as companies play a broader role in society, in the country. Just before the pandemic, it was quite interesting. I'd been at Davos. I was very fortunate to go to Davos. And there was a lot of talk about stakeholder capitalism around the world.
Yeah.
And, how you deal with your various stakeholders. Each stakeholder is equally important to you. And what this pandemic showed us was how important our staff were to us, because without your staff, you couldn't do anything. How important your customers were, and how important the communities around you are. And I think there's been a lot of reflection across our client base, and I know with our firm and with all the banks, the BASA members, around what role we can play in broader society. And I don't think we've cracked that nut yet. We engaged through the various business chambers. During the pandemic, we had a lot of engagement through NEDLAC and in particular with the president on drafting his road to economic recovery, and the role that corporate South Africa can play. I think that's going to change a lot from where we were for hundreds of years, where corporates prefer to keep their mouths shut and just put their heads down and get on with it. I think those days are over, and we have a much broader role to play in society these days. And in fact, at Investec, we've repositioned our purpose. And it's a term that comes from our founders, because it was very ingrained in our DNA, and that is that we want to create enduring wealth by living in society, not off it. And at Investec, we like to think that we can punch above our weight in terms of the impact that we can have on the broader communities in which we operate. And I think that a lot of companies have had to reflect on that during a crisis like this, because as Stephen Kossett was saying on one of your programs, this was a human crisis, not a financial crisis. And it really affected all of us.
I mean, it's humanized us as well, getting to zoom into each other's living rooms and TV rooms and home offices and studies of the kids in the back, and trying to ensure that we can still be productive. But what you spoke about living in society, not off society, reminds me of a great story by Professor Nick Binedell when he was Dean of Gibbs, and he was talking to a group of his banking students and clients, and he said, if you don't worry about the political economy, don't think it won't impact you, because you might be competing to be the biggest bank in South Africa, but if you look across the border to our north in Zimbabwe, you could be competing to be the biggest bank in Zimbabwe if you don't take an interest in what is happening in society around you. So really, the broad social issues and the politics does matter at the end of the day. Do you think things like Business for South Africa, this newfound sense of collaboration and partnership, let's be perfectly candid here, after 10 years of no trust because of state capture, do you think this has allowed each other, if you're looking for a silver lining, the social partners to start to find each other again?
Look, Michael, I had never been to NEDLAC before this pandemic. And I went there quite in a skeptical way, and there was a lot of commonality amongst people. You may come from different ideological starting points, but when you sit in these forums and you actually talk about what you're trying to achieve, you work out that you have a lot of commonality. And I like to think that during this process, business across its various chambers has managed to reach out and work better with the various social partners. That's a good thing. I think certainly from my personal perspective, I'd never engaged as much with the other social partners as before this time. And I think only good can come from that. We can all get frustrated with each other, but at least we sit in a room. It's better than not engaging at all. I mean, we need to engage. We all have the same objective. We just might have different paths, suggested paths, and how we're going to get there. So yeah, from my point of view, it was a very rewarding, personal rewarding experience to go through, and quite encouraging. But it does have its, it has its frustrations as well, because in business we want to move a little bit faster than perhaps government can move.
I recall Mark Lamberti telling me about his time seconded to the board at Telkom of trying to make a decision. He said it was like walking through treacle, trying to get anything done, and that was before we really saw Telkom turn around under Sipho Maseko and others. But it does at least offer some hope that we are starting to find each other across the aisle, so to speak, if you want to borrow from American politics. Richard, a great pleasure chatting to you and sharing your insights into how the pandemic has impacted Investec and how the banking industry is looking to play a meaningful role in infrastructure and building back better as we look to recover from COVID-19. Thanks for your time.
Thanks, Michael. Nice chat.
That was Richard Wainwright, who is CEO of Investec Bank and currently also chairman of the Banking Association of South Africa, with his insights here on Business Tech. With me, Michael Avery.